We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Guyette, portfolio manager and publisher of the Lead Lag Report. Thanks for joining me today, Michael.
Tom, I always look forward to speaking with you because I feel a little more sane at the end of our conversations.
Well, hopefully we can get a little bit more sanity and talk through some of the craziness that we've seen. I mean, it never seems to end. I feel like I say that with every guest. I feel like a bit of a broken record, but there's just so much going on, so much to try and understand. And, you do 5 Twitter spaces a week, 5 or more. And I think you're trying to do what everybody else is trying to figure out what is really going on, right?
Yeah. And just because you figure out what's going on in the past doesn't tell you anything about the future too. Mm-hmm. I mean, that's kind of the problem. Yeah. I have to tell you, it's amazing how I think some people are starting to get it. But a lot of people still are not really understanding how much of an anomaly this year has been. Right. And I keep referencing the same data points to prove that this year has been hell, which is that if you look at the top 20 biggest drawdowns for the S&P going back to 1961, in 10 out of those 20 biggest drawdowns for stocks, Treasuries, TLT as a proxy, the ETF, make you money. They act as the counter, right, to equity volatility. In 9 out of those top 20 biggest drawdowns, going back to 1961, going back to pre-Volcker, including the 70s, in 9 of those, Treasuries lose, but they lose a lot less. This is the only year in history where Treasuries have lost more money than stocks. Now, people will then say, well, you should have seen that coming. It makes sense. Okay. One thing is to say stocks and bonds lose money. Another thing is to say how it happens, right? So never mind that being an anomaly, the idea that the risk-off safe haven has done worse than the risk-on play. Mm-hmm. When you look at stocks as a standalone, the percentage of weeks the S&P has lost money this year is 63% of the time. So you take all the weekly data, look at the red weeks, 63% of the weeks the S&P's lost money in 2022. The only other time that happened was 1931 during the Great Depression. So even if you just take out the bond portion of this, even just the path of stocks as a standalone is really abnormal. Right. And I don't know if people really appreciate just how much of a data set anomaly outlier 2022 has been. Mm-hmm.
Well, yeah. And I think that kind of goes to the point that this is going to only be seen retrospectively for what it actually ended up being. And it's really difficult while, in the moment or in the forest to be able to figure it out because like you say, there's no real analog for it. And there's so many different factors to take into consideration. You recently tweeted that everyone thought Lehman wasn't a systemic risk until the broader stock market began to crash a week later. So how in your mind does that contagion spread? Is it through investor behavior needing to sell other assets in order to cover, or could it be more structural leverage or derivatives tied to more mainstream assets?
So, my handle is Lead Lag Report, and Lead Lag is kind of the key point here, right? That there are these areas that lead first and then areas that lag, and you can maybe take advantage of those lags. The thing is, like this year, a lot of these mini cycles have been really desynced, right? So you have like the leaders become laggards and laggards become leaders as far as indicators and signals. So the whole point of that Lehman tweet was not to make the analogy that we're headed for 2008, like great financial crisis, although who the hell knows, right? It's that back then when Lehman filed for bankruptcy, there was the market was actually fairly stable. And the White House said, this is a testament to the resilience of the U.S. markets. Mm-hmm. And then a week after Lehman filed is when everything collapsed, right? So my point is that, because there are these lags, people seem to get overly comfortable if something's not happening right away, right? So I reference that because in the context of what we've seen with FTX and this crypto crash broadly, I mean, I don't know. It's not my base case. I don't think it's going to play out anywhere near like 2008, but for all we know, there could be a delayed response to equities, right? That's sort of more the the point. And I have to tell you, it's the beauty of FinTwit and Twitter is that you end up obviously getting your voice out there, being able to counter a lot of the false narratives around my strategies. But you also have a lot of people that are remarkably short term that are not even doing basic historical analysis to see that whatever they think now could completely change tomorrow, because markets are very good at fooling everybody.
Mm-hmm. Yeah. So, I mean, it's interesting that you bring up 08 and Lehman. In a tweet that I saw, I think it was yesterday, Michael Burry said, "You have no idea how short I am right now." And, it just seems there's unfortunately some analogs towards that. But I want to go back to that question. Do you see it more as investor sentiment that ends up taking more liquidity out of the markets, or is it more of a structural, maybe derivative or leverage type issue that could lead to that crypto kind of, I guess, crash leading into more equities?
Yeah, so it is the leverage, right? And the sentiment is tied to the leverage. I've used that line before, right? It's overconfidence leads to leverage. Leverage leads to crashes. Right? I mean, that's
they're both interlinked.
Yeah, it's like you don't have leverage unless you have extreme confidence that the future will look like the present, right? So look, I have been poking holes at a lot of these narratives going back to February, March of 2021. It's when I started putting the lumber and gold eyes on Twitter because I saw these, ridiculous laser eyes, which, by the way, that was the top for all this stuff, right? Which is another sentiment tell, right? It's like when it becomes, I use that line so many times, when investment becomes religion, it's time to lose faith. And that's when everything started breaking down. And that's not me trying to take a victory lap, because there's a lot of pain that people are going through. There's a lot of people that got sucked into these narratives around cryptocurrencies, and there have been a lot of frauds, as we're seeing with FTX and some of these other exchanges, right? That now are basically going through a digital bank run. The equivalent of George Bailey from It's a Wonderful Life is happening now, on the blockchain, right, so to speak. But having said that, this is what happens in markets. People get overly excited, they over leverage, they're overly confident, and then the tail wags. Now, the problem is, or the question rather is, can a margin call, which is really what's happening in the crypto space, right? Can a margin call be isolated to just one asset class? So usually the answer is no, right? In other words, when you have a margin call on one asset class, there's lags, right? That results in all other asset classes feeling it, because people and institutions have to raise money, and if they can't do it from their crypto investments, they do it from their stock or bond investments, and that creates a cascading kind of butterfly effect. That, I think, is what the market probably is wrestling with the most. The market meaning non-crypto, everything else that's got risk. But it is interesting, right? Because this is happening at the same time that we're getting what seemingly looks like some good news around the inflation front, right? What could finally be a peak. I mean, the whole reason you had a pretty strong move, the last several weeks here, is because the inflation data came out weaker than expected. Still very high, right? But it's like, if you cut off the risk of the runaway inflation, you stabilize bonds, which is the whole melt-up argument I made October 2nd. That's enough. That's enough to cause, continuation. The question is, can that swell what is a non-zero, low probability potential systemic event from the crypto crash? And the reality is nobody knows except for the hindsight.
Michael, I'd like to take a bit of a step back, if we could, and kind of get your explanation of how you see all of these rotations starting to work. You use the word melt up, and there are some particular people that use that word specifically. So I would like to get your, let's say, your 5,000 foot view on how those markets really start to interplay, what those rotations are, from risk off, bonds, and get your idea of how that melt up ends up kind of playing out.
Okay, and this goes back to sort of the hell of this year, right? So again, risk off has done worse than risk on. Anybody that looks at my mutual fund ATAX, my Rotor ETF, my Jojo ETF, the ETFs have indices. Anybody can look at them. They go back way further than when I launched the ETFs. You'll see why I launched the funds. The reason they've all gotten through such a nasty drawdown is because Treasuries failed as the safe haven. Right. So it's important to know for the audience that risk off doesn't mean no risk. Risk off means default risk off. In other words, when there's heightened volatility in equities, historically there's a flight to safety, because the idea there is that if volatility is rising for stocks, bankruptcy risks increase, credit spreads widen, so you want to go into the U.S. government debt side because U.S. government can't go bankrupt, at least in theory, right? So, okay, and the signals which I use, which are all rules based, in the funds, they've all been risk off and defensive the bulk of the year. That's what's been so maddening. The signals have been right. The expression is what was wrong. Treasuries. Now, yields are a lot higher, so you have the potential now to make money in treasuries whenever another risk off phase comes. I suspect that the melt up scenario is still very much in play. Okay, meaning stocks and bonds, right, would continue to run higher, meaning stocks rise, yields drop in the bond market. But we still have a recession out there. The damage is still done, right, from these high rates. Housing is pretty much, if you were to market housing, we'd probably be in outright depression because nobody's transacting, right? There's like nothing to even base pricing on. So because of that, I think you're going to have risk off dynamics, at least I hope, selfishly, come back. Meaning after, a bullish move in equities, which really started around that October 2nd tweet I put out, treasuries probably keep rallying and price dropping yield as the stock market goes down, which would be more classic risk on, risk off behavior. That would be very welcome. I know a lot of people focus on the melt up terminology. And by the way, melt up is just a term that means essentially FOMO with no clear change in fundamentals. It happens in bull markets and bear markets. It's very sharp, sudden, surprising on higher risk assets, right? But at some point that fizzles out, and at some point, hopefully the real risk on, risk off dynamic returns. And that will be the most important dynamic for everybody, because at least if treasuries go back to being the safe haven, at least there's somewhere to go then, right? It's like the dilemma that really slammed my strategies, my funds. It's the same dilemma that risk parity strategies have. You look at risk parity, Ray Dalio's claim to fame, Bridgewater. They've gotten destroyed in this, and I don't care how many people will attack risk parity. It's very valid in terms of the historical research. It's not deniable. It's data, right? So risk parity is going through an anomaly this year because the treasury side, the counter asset, is acting worse than everything else, right? When you would think it should be the opposite. So it will resolve itself in time. And I have to tell you, going back to kind of short-termism and the way that people think, the recency bias is really incredible. People really do think that treasuries will never be a risk-off safe haven play again, that it's going to keep acting as volatile as equities. This is like complete insanity to me. How is it possible that you have a highly leveraged system where your collateral, that all the leverage is based on, acts more volatile than what you're leveraging? It literally, it's not even possible. It's not even sustainable.
So, as part of that, let's say that melt up thesis, is it just based on a reversal of this real negative investor sentiment? And wouldn't a dramatic melt up be more so based around a pivot or reversal of current Fed tightening?
Okay, so a couple things. So first of all, I know everyone says pivot is bullish. It's not. I mean, historically, pivots tend to happen when the market's already taking a big hit. The thing, and let's go back to recency bias. I mean, 10 years is not exactly recency bias, but it can kind of somewhat fit in that framework. People got very used to the idea that, low rates are what you want to see in a bull market. It's not true. Historically, you want to see rising rates because it means the economy is stronger. It means growth is improving, right? It means the demand for money is increasing, right? So the pivot is actually the bearish argument, right? It's not the bullish argument. So, and remember, keep in mind,
because we're only going to see a pivot once things get truly painful around either the credit market, the equity market, something like that, right?
Right. It'd be effectively spread widening in the bond market, default risk premiums increasing, and then the very real risk that a lot of these zombie companies suddenly have mass bankruptcies. But the point is, it would be too late by the time that risk is there. So the Fed would do what it always does, which is act with a lag itself, right, after the fact, and that's why it becomes problematic and hard to stop, right, until they overshoot on the downside with liquidity, and then you have the same boom and bust cycles we keep seeing. So, I think people give the Fed too much credit around how they've quote unquote engineered this decline, and I also don't believe the argument at all that the bond sell-off is purely 100% because of Federal Reserve tightening policy. I go back to, if you were to look at those top 20 drawdowns for the S&P and look at that against Treasuries, you've had plenty of rising rate environments where Treasuries still act as the counter asset. I'll give you an interesting stat. If you were to look at the, and a lot of this admittedly is because you had such a low yield on the starting side of things. If you were to look at where Treasuries bottomed in yield, topped in price, long duration, TLT is the proxy. I think it peaked around like August of 2020. The drawdown in Treasuries, which started long before the Fed started hiking rates, the drawdown in long duration Treasuries would rank it among the 5th largest declines for the stock market in history, going back to 1926. Meaning, what we've seen in Treasuries in the bond market, there is no precedent for. It is unbelievable how much destruction there's been, and that's where the real dislocation, and I think where the real opportunity likely resides.
Because at some point that has to kind of boomerang back.
Well, it's just like you always hear that expression when it comes to commodities, right? The cure to high price is high price. Well, I mean, the cure to high yield is also high yield, right? We can argue that 4% maybe isn't high yield, but the reality is, we don't know if the Fed already over tightened. I mean, what if inflation does crash? So let's play out a scenario. China at some point is going to reopen. They're going to. Culturally, they're not the same from a consumerism perspective as the West. So I'm going to argue that China reopens. That's a massive disinflationary force. Suddenly, now everybody and their brother and their mother's exporting. Again, all the factories are fully operational, up and running. Once you get rid of the zero COVID policy. Okay, now let's take it a little step further. So they start flooding the world again with goods. Okay. Their currency has a band around the US dollar. The yuan has a band against the US dollar. So what if the dollar peaked? So now the dollar weakens, which you would think is inflationary, but could be countered by the disinflationary exports from a reopening China. And as the dollar weakens, the yuan weakens, which means even more cheaper exports to everybody in the world. You could see conceivably a shock move lower in inflation, right? Which means that, the Fed probably already over tightened.
Just to play devil's advocate, though, couldn't the argument also be made that, some of the, let's say the structural, the real drivers of some of the inflation, let's say specifically energy that China needs to really be importing to produce all of these items, wouldn't that be inflationary for the economy as well?
Yes. So that argument is out there. I don't disagree with that argument, but I also feel like you'd assume that the Chinese authorities are aware of that dynamic, right? I mean, look, oil is probably going to still stay elevated, but oil is not the only cause of inflation. I guess is sort of the broader point. So you'd have certain areas be inflationary under that scenario, rising oil because of suddenly the factories are coming back in and people are moving about more, obviously in China. But my point is the disinflationary effects of the export side could counter the rising inflationary pressure from the oil side, right? So that's why I'm saying I think this is a lot more nuanced in how it could play out than simply being simplistic and saying, well, China reopens and inflation is going to go through the roof. It may not be the case, because it's not just about oil.
Yeah, it's an interesting point that all those exports start being deflationary from the supply side of everything that has been constrained. You do a Twitter Spaces live call every weekday, and I had tuned into one with an oil analyst that was very focused and specialized on the OPEC oil flow. So do you agree that the 2 million barrel per day cut wasn't necessarily to spite the US and was more so just a reaction to their current output capacity and projection of a trough of demand due to this global recession that they see coming?
Yeah, I mean, probably. I'm not very big on sort of the conspiracy theorists of trying to stick it to the US, although you never really know how the politics play out. But look, I think OPEC, like everybody else, is trying to respond to volatility in demand cycles, right? In this, and also volatility on the supply side. I mean, every time Biden, does something with the SPR and releases oil, right? That obviously affects everybody else, as we've seen, because oil hasn't recovered to the prior peak. So and I go back to this is why there are these lags, right? In policy action, price movement, and then unintended consequences that, of course, always result. But I don't know. It's not particularly an area of expertise for me, but I don't get the sense that it was out of spite.
Mm-hmm. Well, on that kind of topic of the SPR, do you think the outcome of the election could possibly cork the drains out of the SPR now?
Yeah, presumably, right. I mean, split government is actually not a bad thing. I mean, that's just the reality. Mm-hmm. It's like, I put that tweet out before. It's like, the Real Inflation Reduction Act is a split government.
Yeah, that's exactly where I was going.
Right. Yeah. So I think there's validity to that, and also just in general, like, the best thing to do anyway, independent of inflation, is lower government spending. It's like, I keep going back to austerity is more powerful than interest rates, mm-hmm. right? In terms of lowering that inflationary pressure longer term, right, beyond what we're experiencing now. And this is the thing about this kind of melt up argument. So I go back to, it's about conditions. Okay, sentiment was very extreme. Midterm years tend to be very bullish when you enter the best 6-month period of November to April, right? And that's because of the split government, historical sort of behavior. So all the signs are there for continuation of a run higher, despite the Fed maybe trying to play whack-a-mole against an overly optimistic investor. I think in many ways the Fed is maybe trying to counter with their word seasonality, mm-hmm. right? Because the data's there. I mean, this is the best 6 months tend to live in the midterm, presidential election cycles for equities. So, yeah, I think there is something very powerful to having a split government for the equity bulls, especially now if inflation's peaked, which remains to be seen, but it's at least positive, seemingly going in that direction.
Mm-hmm. Well, you and I have spoken before about your views on utilities and different commodities and even lumber in previous conversations. So, when we saw that lumber price spike after the COVID crash, was that an indication to you now so that a lot of these risk relationships are broken right now?
Yeah, so a couple of things. The lumber's obviously come down quite hard, right? Which makes sense because housing demand's falling off a cliff. I mean, again, I go back to the link of housing to the economy is through the transmission mechanism of housing starts, right? It's the framing when it comes to housing. The thing is, housing prices are still elevated despite their complete collapse off their prior peak. So, last I checked, it was trading around 400, 420 or so, 410. You go back to the historical range, the low end of the range is like 200, per board feet. So lumber could go down another 50%, right, just to get back to historical norms. And that would be sort of, again, a sign that housing really just completely stopped in terms of construction, which, by the way, is what the Fed probably wants, right? Anyway, that dynamic is still playing out. Now, the thing is, usually when lumber is weak relative to gold, like it has been the bulk of the year, it means higher volatility for stocks. It also usually means treasuries are the place to be. They have not been this year. That's been the help. But, the more that it becomes entrenched that housing is at a standstill, the more likely bonds probably do well, right? Because you're not going to have any demand for mortgages. I mean, those who are going to be transacting for housing are probably going to be doing it only in cash, not from leverage, because the interest expense is now so high. So at some point that will filter through into lower yields, which again I think means treasuries, high quality bonds probably are better allocation as opposed to a better allocation than stocks.
Right. So does the real dollar strength that we have seen this year have a big role to play in the change of many of these relationships? Is that possible?
Yeah. So this is one of the other, talk about anomalies, right? Usually when the dollar is strong, yields drop. Treasuries are strong as well because foreign money is hiding into U.S. government debt also. The dollar, it's like, I've used that joke before, right? If I were to tell you a year ago the dollar would have been the best inflation hedge, you would have thought I'm out of my mind, right? But that's really what happened. Mm-hmm. So now the thing is, the dollar has been unrelenting in its advance. Euro's been weak, yen's been weak. We knew all this. And I was very adamant earlier in the year, I think even on your show, saying, the dollar is acting like there's a sovereign debt crisis coming. And I've been pounding that table for a while. The thing is, the dollar move has been so persistent and almost treated as a given that it makes me think that you're not going to have a sovereign debt crisis because the policymakers would be stupid to not see it coming at this point. Mm-hmm. right? It's like you see a train come at you and it's taking a while to come at you, and you're still staying on the tracks. You're not going to move at some point, right? So, and I think it partially explains why the dollar broke down so heavily, right? And it wasn't just a function of the inflation data came in less than expected, but you were pretty exhausted in terms of the dollar movement, right? More broadly. So again, you cut off the tail risk of a sovereign debt crisis. Again, that's another catalyst, I think, for markets, for equities, at least for a moment in time, to do well. But again, I want to emphasize this point. It's like, I don't think necessarily you have new highs, right, in equities. I think the bear market will take some time to play out. Even if the Dow were to suddenly close positive for the year, let's say magically between now and end of December, right? The Dow Jones Industrial Average has positive gains. It's still down, because that's the thing about looking at equity performance. Nominal is different than real, right? So at the depths of the decline in equities, there were a lot of stats that basically showed that this is the worst year for the equity market in history in real terms after inflation, right? Because the drawdown, as big as it is, now you got to tack on like 10% to it, right, for the real loss. So I go back to, it's like this year has been just devastating. The good news is the year's close to being over, and the good news is now you've got some yield and you've probably corrected and undone a lot of the bond froth. But this has been one for the record books.
So, if we've seen the dollar peak, couldn't let's say the counter argument to be that we see another wave of dollar strength if there's more international volatility, like what we saw in the UK and Japanese markets, causing more outside demand for US dollars?
Yeah, so there's a difference between the trade and then the trend, right? So my argument here would be the dollar weakness probably holds in at least a little bit. I don't think you're going to have a very big decline beyond what we've already seen. But let's play it out. Let's say suddenly the dollar resumes its advance. And let's say it happens this time around with yields dropping, meaning you're sort of more classic risk-off behavior. Dollar rises and money goes into treasuries. That, to me, would be a massive warning sign of a sovereign crisis. You see the behavior of the dollar and treasuries this time correlating the way they used to, right, in risk-off high-stress periods. Then it's, I think, time to really be cautious. I don't think that's outside the realm of possibilities by any means, right? But I always go back to path matters more than prediction. So there could be a sovereign debt crisis still out there. It may be delayed for now, but how we get to that point is really going to be the key for anybody that's listening to this.
And when we see these real sharp moves up or down in the dollar, does that velocity of those types of moves matter a lot more and need to be analyzed differently than, let's say, moving down 10% over a year versus, let's say, 4% up or down in a week?
Yeah, this is all about speed. You're hitting on exactly the point. It's not just speed for currency; it's speed for yield, speed for policy, right? I mean, you just had the fastest rate hiking cycle in history. In history, fastest by speed. You just had the biggest yield spike for treasuries. I think I see some stats. It's like the biggest move in yields since 1788 or something. Like, who the hell knows how accurate that data is, because that yield is. But what I'm saying is, like, it's very clear, right? It's like, it's what's so crazy about anybody that's like seeing even my own strategies and they're not understanding everything I'm showing. It's like all these stats are making it very obvious that this is not normal, right? And if you're developing a systematic approach and have that framework, and you're in an anomaly, and it's very clear we're in an anomaly, what are you supposed to do? You have to just take it. You have to go through it. You have to hope it ends. Which is, again, my hope. I think we are finally there. I'm actually the most optimistic I've been, just from a macro perspective, really since like middle of last year. Middle of last year was very clear to me too. It's like, why is it that despite all the stimulus, why are small caps still going sideways? This is in 2021. I was seeing back then also that things just didn't look right relative to what was going on around us. The reopening, and yet small caps go nowhere. So we've been in this really messy period for a while of just things being desynced. At some point, things normalize, which again doesn't mean higher highs. It just means correlations get back to the way they used to be.
Right. So in your opinion, is the only real thing that matters for gold is dollar weakness? Is that relationship still let's say, the number one driver?
Yeah. So I put that piece out at the lead lag report. a lot of people have been perplexed that gold has not done better. It's done okay. It's on a relative basis, but a lot of people are perplexed. It's funny, right? Analog gold has done better than digital gold. That whole narrative around cryptocurrencies, Bitcoin being digital gold, might want to be careful with that narrative, right? Because it is just a narrative, right? So a couple of things. I think for gold to really have a move, and we've talked about this before, one, you need to have a feeling from allocators that the bear market will persist, right? Because gold is the ultimate diversifier, and that it really doesn't correlate to very much. So the more that it becomes entrenched in that the duration of the bear market will play out over time means more diversifiers, more at the margin demand for gold. I do think that a weakening dollar here will serve as a catalyst for gold, because if the dollar now is no longer the number one risk off safe haven play, well, you only have two others. Utilities might be the possible third, Treasuries, right, and then gold, because usually it's from an asset class perspective, it's Treasuries followed by gold followed by the dollar. Those benefit from heightened volatility and tail risks and equities. So yeah, it could very well be that the dollar's pain ends up being gold's gain, because money still would look for another risk off safe haven, and the dollar's pretty tapped out in that.
Do you see any type of environment where we could see gold and the dollar move higher together?
Yeah, sure. I mean, you've seen that in other countries in their local denominated currencies, right? So not impossible. Look, I think I always make this point. It's like you want to diversify by having things in a portfolio that you hate, right? And you hate the things which are not performing that well. Well, a lot of people hate gold for a very particular reason, because it hasn't really performed that well. It's probably why it's the best diversifier, right? So if this year has proven anything to anybody, it's that you should expect strange things happen counter to historical relationships in a really extreme way. So usually you would not think a strong dollar would result in strong gold, but you never know.
Do you do any thinking towards how gold miners fit into that as well? Are they only going to get attention as a byproduct of gold's momentum?
So it's interesting, because I've done quant backtests trying to basically see if using the price of gold gives you an edge on when to time gold mining stocks, right? And believe it or not, there really isn't that much of a link. So I know a lot of people will argue that as gold rises, the miners should do well. It's not. It's actually fairly loose, because a large part of the miners has to also do with oil prices. So you can't just look at gold by itself. It's about the price of oil, as the mining is taking place. Miners, as you know, are very volatile, right? Which is not necessarily a bad thing, but it's a very volatile trade.
Need to understand them.
Yeah, no, right. And it's which means if you're going to be an investor, you have to size it properly. I mean, look, a lot of these miners, from what I've seen, look pretty cheap. But cheap against high volatility means it's hard to stick to it, right? So I think there is an argument for miners. I just don't think it's as clear as it's because of gold.
So, Michael, we're starting to see some massive layoffs, and maybe a great example is Amazon, which is obviously driven by consumer demand. So do you think that this period we're currently in will be revised as being included in a recession?
Maybe. What's interesting about the layoffs, which I think is it'll be interesting to see how this plays out, because what's been the big issue that small businesses have had is that they can't find talent, right? People don't want to work. Okay. Well, now you got a whole bunch of younger people that are going to be unemployed because of the crypto collapse. Now you've got a bunch of people that are being unemployed by the very large tech companies, by the Amazons of the world as well. So you've actually got a supply of new labor coming into the workforce, which could push wages down and actually result in better margins for small caps, for smaller companies, right? Because now everything they've been complaining about is coming to them. Yes, it's still a slowdown in consumer spending, but my point is the fact that it's happening first with large caps at such scale is interesting from a lag perspective, right? Because it may actually be beneficial for the smaller businesses that have been trying to fill those seats, right? This is more just kind of a thought experiment as far as how these cycles kind of play out. Look, tech is going to be, I think, having a hard time as a sector for a while. If one of the reasons that tech overexpanded was because of a zero interest rate policy, well, now you don't have that for a long, long time. Barring some kind of financial crisis that sends interest rates back to zero. You never know, but that's not something one should hope or bet on, I think. So from that perspective, there is I think a reallocation happening, or that will be happening in the labor force broadly, away from the sexy tech big companies, to maybe everybody else, and that would be beneficial for everybody else versus the concentration of top talent going to the biggest names.
And of course, one of the other points that you've made about how tech has really expanded so much over, let's say, right after the pandemic, it could be that this is just kind of the tide going back out from such a large expansion during that time, right after, let's say, the lockdowns happened and everybody had to move to working online, right?
Yeah, I think that's largely true, right? I mean, I think there's an element of that, but again, it's like I keep going back to, I don't think what's happening is inherently negative when it comes to seeing these layoffs at the big companies, right? I mean, they also were. I mean, how many? I remember. I'm sure you did too, right? It's like how many hires was Amazon trying to do the moment it looked like we would reopen, right? All the big companies were responding to the same narrative of everyone else early 2021, which is that we were about to enter the roaring 20s, right? It's why you had the inventory buildup. Everyone was trying to get ahead of this massive consumer spending surge, which came, but didn't come as much as I think was expected, because the Fed basically just came in and started countering it.
Right. So I think two of the biggest concerns of, let's say, Main Street at this point are recession and how inflation will continue to affect them. So if the Fed is successful and kills demand and thereby killing or bringing down inflation, once they reverse course, do you think we could see inflation that would be structurally present come roaring back with a vengeance?
Maybe. So this is sort of the inflation dynamic is not just a function of central bank policy, but it's a function of conditions that don't favor competition. So to me, the structural inflation which is partially related to supply side, is very simple. Pretty much every industry is an oligopoly. I mean, it's just true, right? So when you don't have competition, you don't have an incentive to lower prices. So you can argue from that perspective, which is why margins stay elevated, right? You can argue from that perspective that inflation is structural, not because of the amount of dollars that are in the system, but simply because decades of consolidation put us in a place where just a few players have all the pricing power. Right now, the idea that it suddenly comes back with a vengeance, who knows? I mean, you can always have a supply shock, obviously, and the world is full of tail events nobody can see coming. I tend to be much more in my mindset disinflationary or even deflationary, because I think at some point, I've used that line before, debt's deflationary when you cannot issue more of it. Right. So at some point, the debt load puts us in that Japan scenario. Debt to GDP is pretty close to that, right? Sort of the critical threshold, right, where there's no turning back. So we'll see. But practically speaking, I don't know if any of this really enlightens one in terms of where to allocate. Right. I mean,
that's a good point.
It's hard enough as it is to kind of figure out the current environment, the here and now, and the likelihood of inflation persisting or not. Who knows 10 years from now?
Well, Michael, that's, I think, a pretty good place to wrap up today's conversation. Was there anything else that's on your mind that you'd like to add? Maybe I know you've been talking about and thinking about Brazil a lot more lately. Is there anything particular with the election, or why Brazil is so interesting to you?
Well, I mean, so Brazil's definitely performed better than the U.S. markets, but it's interesting, right? Because at the core, the most important dynamic, just I think, this is just my own spitballing here. The most important dynamic, which makes sense to me to focus on, which will have a lot of implications, is the end of large cap U.S. dominance in terms of being the only place to allocate to. Right, which has been the case, for the last decade. Small caps relative to large caps peaked in 2013. The ratio of small caps to large caps is back to 1987 levels. Emerging markets have been death for a decade. Let's face it; they've done nothing, just volatile sideways, nothing momentum, whipsaw city. if the reason why the U.S. was the only game in town was because of zero interest rate policy, you no longer have that. That may mean that it's not just going to be about the S&P anymore. Now, that's an important dynamic for traders and for allocators in particular, because it's very hard to beat the S&P when the S&P is the only game in town, right? So I think that's going to be sort of thematically the most critical thing. And what does that mean even stylistically? It means a move from growth to value. And part of that move from growth to value means from U.S. to places like Brazil, where their own stock market averages are much more value-driven sectors. So it all, I think, does kind of stem. It all ultimately goes back to, is large cap, in particular large cap tech, right? Is that era of unrelenting outperformance over? This year seems to be a pretty big check on that.
Mm-hmm. Interesting. Well, Michael, I want to thank you for your time today. Just a reminder, you do a Twitter Spaces Live show every day of the week, right?
As much, sometimes twice or three times. Yeah.
Yeah. So reminder for anybody listening to check those out if you'd like to. Of course, that's at Lead Lag Report and leadlagreport.com, right?
Yes, everyone, please make sure you subscribe down below on the YouTube channel and follow Tom, because he was a great interviewer.
Thank you very much, Michael. And you put a lot of great info into the space as well. And I appreciate you sharing some of that with us today.
I appreciate you.
Thanks, Michael.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.